Hi, Jim Yant from Golden Years Advisors, the home of the Kairos formula. We're in the home stretch on our May updates. What does this mean for portfolio positioning is the final segment of this. We outlined our upfront case that we think this is a mild recession. It's a growth slowdown, a profit recession that we have to muddle our way through. It's the most likely situation, but there's a lot of risk on the table. And we've enumerated those risks that could happen. Banking crisis, debt ceilings, rates, Fed being too aggressive, all of the above. What are we doing from a portfolio position? Well, the following. And what we're putting on this page is what we've already done, is the key thing I just want to point out to y'all. And every client is going to be different, but we made some broad comments because it applies directly. So on the equity side of whatever your equity allocation is, because some people are closer to a 40% equity, 60 bonds. Other people, it's the reverse, 60-40, heavily equity. But whatever is your equity piece, what we've already done is taken 40 to 50% of that equity, and we're using two third-party strategies that we've used in the past that we really like, and they've worked for us, that can quickly adjust on a daily basis from what I'll call offense to defense. Those two strategies are S&P Prism. It has indicators and algorithms that it looks at. And if it sees that it says, I don't like the way things are going, you'll see it jump to where it thinks is the best place. As we speak right now, Prism is 41% in bonds. It can also go, and that means, and it's about 5% cash, and the rest is sitting in a S&P 500. But depending on what it sees, it'll jump either bonds, cash, commodities, what makes sense, offense to defense. The other is, oops, I don't have my pointer on apparently. Sorry about that. The other one is the Sherman 3090. Same situation, very nimble on a daily basis. If it sees that any asset class, whether it's an index like the S&P or the NASDAQ, or just large categories like small cap, mid cap, large cap, even bonds, if any of those fall in strength relative to cash, money markets, that's when they'll evaluate whether they should be playing more defense. And you'll see it, for instance, Sherman popped just today and went from a 90% equity position. That's why it's called 90-30-90. The most offensive it could be is 90% equity, down to a 30% offensive position. 60% of the portfolio was in cash and 10% was in bonds. So we're outsourcing that piece, like I said, about 40 to 50%, because we believe, as we've always told you, you diversify more than asset classes, you diversify the timing of the money, the purpose of the money, and how you're managing the risk of the money. So we have about half of the equity risk on third party. Other portions are ours on the GYA, Golden Years Advisor side. And the largest single position that you'll see in your entire portfolio is something that we call buffers. We shared them with you back before COVID hit. And that single biggest holding is something called P December. I'm going to jump real quick over to what that means. This is literally the vendor. The vendor is P December. You can kind of see on the side. But what Buffered Solutions, and this one in particular, is, it's an exchange traded fund. That means we can buy and sell it anytime during the day, low cost, tax efficient, etc. But inside, under the covers of this exchange traded fund, there are options that are trying to limit downside, but provide upside. And so we bought into this several months back. And what it does is, for a 1-year time period, the deal is, what's locked in by the options is the upside that we can capture is if the S&P is up to 18.37%, that's how much upside we could capture. If the S&P goes higher, we don't get it. But anywhere above this line here, and just so you know, the dark line would be your account value. The lighter blue line that you see, that is the reference, in this case, the S&P 500. And when markets are falling, and that's what's happened so far this year, if you look way over to the left, sorry, I got a contact right in the middle of the page. My apologies, did not see that. I'll slide it up a bit. But when the market fell, your account value will not fall as quick because you have those protections. But likewise, when the market rises, and it hasn't happened yet because you see the dark line is above the light blue line the whole time, it'll eventually lag. But wherever the S&P ends, if it's up above in this space up here, you'll get all that upside. If it goes above it, you do not. If it ends up negative someplace in this downside, that's where the buffer is, and the buffer is good down to a 15% loss, then you would have no pain. You would not have the loss. If it falls further than that, say it drops 16, 17%, well, the first 15% isn't on you, but you would have that extra 1 or 2. So that's what the biggest position is in your entire portfolio. And it's heavily in our GYA strategies. It is what the buffered growth strategy is allocated to, the GYA buffered growth, but we also have those same buffers inside every other equity allocation we have out there: global growth, low volatility, and PowerFlex. And the reason why we picked it, from where the market is now, we have downside protection to where last year's lowest point was. October of last year is about approximately 14-ish% away from where we are now. So we'd have protection to about 100 points or so beneath it. So if things get crazy, whether it's banking related, debt ceiling related, just economy gets worse for some reason, we at least wanted to protect to where the bottom was last time. So that's on the equity side. On the bond side, because everyone has different bond allocations, we're in the shorter things, floating rate things, or market neutral things. As a recommendation, whenever we're talking with people who are needing to pull money out of any of the accounts, let's just take them out of any of this risk. Let's don't have them in specifically the bond or the equity side. We're saying, well, why don't we just put whatever you need, like for the next 90 to like a full year, whatever amount we're going to set aside if we think there's some big withdrawals coming. Let's just either put it in cash or T-bills. And that's just a safer way to deal with it. So that's how the portfolios are already positioned. We'd be glad to discuss any specific things that might be concerns for you, or ways that we could de-risk more, or some of our future actions that we plan to take. But the point is, we think this is the right positioning for now as we head into all these concerns. All right. I hope you had, because by the time you see this, Cinco de Mayo will be in the rearview mirror. And I can't wait to a lot of these games of chicken, whether it's Congress or it's the Fed versus the market in terms of interest rate. All these games of chicken are in our rearview mirror. Okay, keep the faith. We'll keep our eye on the markets. Take care.